Welcome to the Compass series of conversations with leaders charting the course in impact investing. I'm Ben Thornley, and thank you for joining us. Today's session is co-hosted by Tideline and the Institutional Limited Partners Association, and I'd like immediately to invite my co-moderator to get us started, Matt Shea, ILPA's Managing Director of External Affairs and Sustainable Investing.
Hey Ben, thanks very much, and thank you again for having us here today. Um, Good morning, good afternoon, good evening to some of you. For those I haven't had a chance to meet, I lead external affairs and sustainable investing with the Institutional Limited Partners Association. We're an industry association that represents more than 620 limited partner organizations investing in private markets globally. It's a pleasure to be co-moderating the webinar today with you, Ben, and to share our recent research with everybody on the line. Over the past decade, impact investing has moved from the margins into the mainstream. And as institutional investors begin to represent the majority of impact capital, many are actively looking to grow their allocations. The momentum is real. But as fiduciaries, institutional LPs don't just ask whether impact matters, they also ask how it can be pursued with the same rigor, accountability, and confidence as any other part of the investment portfolio. And that's really what motivated this work. ILPA's mission is to empower limited partners and help them be as effective as possible in their roles as investors in private markets. And so we wanted to understand, is the impact investing market today truly ready to meet institutional standards? Do investors have the data, scale, infrastructure, and guidance that they need to deploy capital efficiently and with integrity? So together with Tideline and Campbell Lutyens, we engaged a group of leading LPs to hear directly from them about what's working and what isn't. Ben will get into the details in just a moment, but what we found shows a market that's making progress. Investors are learning from one another, aligning around core frameworks, and building the confidence necessary to deploy capital in the impact space with the same rigorous approach that is applied across their broader portfolio. At the same time, there are clear constraints, especially around financial track records, impact data, and the scalability of opportunities. These gaps still make it harder than it should be for institutional LPs to participate at scale. The report we released is not just a diagnosis, it's a roadmap. It's a tool for market participants to focus efforts, coordinate solutions, and engage together in a way that furthers the ecosystem. And that's exactly what today's conversation is about. So if you haven't seen the report yet, I hope you'll head over to ilpa.org to get a copy and check out some of the other resources that we've been putting together alongside our partners like Tideline to keep the dialogue moving forward on this important topic. So with that, Ben, I'm happy to hand it back to you to provide a brief overview of our findings before we bring our panel online to discuss further.
Great. Thanks so much, Matt. It was a real pleasure for Tideline to have worked alongside ILPA and Campbell Lutyens on the research. I want to begin by quickly overviewing the framework we'd created together to assess the state of the impact investing market's development, and we're going to share a few slides. We call this our institutionalization framework, and you can think of it as capturing the requirements of any typical large institutional fiduciary to participate actively and confidently in impact investing, just as they would any other investment opportunity. We tested this framework in interviews and surveys with over 40 allocators, and we're encouraged to think it might have value in the years ahead, as you said, as a dashboard on the state of the market's progress. The framework includes 3 layers, noting the importance of internal market and external operating factors. However, our focus was primarily on the middle section that you see here, the market conditions that shape institutional investor participation. To touch briefly on each of these, data means the availability of financial and impact performance information at the transaction and market level. Scale means the availability of a large and diverse investment opportunity set. Infrastructure means robust regulatory scaffolding, intermediation, and analytics. Resources means harmonized voluntary standards and guidance. And networks means formal and informal channels for LPs to coordinate and collaborate. Over the course of the research, we discovered some clear areas of progress, as you said, Matt, and of opportunity. We'll begin with the places where more work remains, the data and scale pillars. LPs collectively rated the current state of data and market infrastructure at just 2.7 out of 5, with most emphasizing data as the primary constraint. On financial data specifically, approximately 90% of LPs cited gaps in financial performance information as a major challenge. As he had mentioned, especially track records, exits, and distributed to paid-in capital. On impact data, LPs talked less about the scarcity of information and more about the difficulty of interpreting and comparing data. In fact, LPs are becoming more sophisticated in their understanding of impact data. They recognize that impact is context dependent and challenges like metric standardization and benchmarking are likely to continue. However, they do hope for greater convergence around a core set of impact metrics by sector or theme. And on scale, impact strategies remain heavily skewed toward both earlier stages of investment and first-time fund opportunities, nearly twice the share as in non-impact markets. This has led to the development of a much more concentrated and less diverse market overall for larger investors, and of course, a relative lack of data. Without the right data and scale, implications include the need for LPs to expand their risk tolerances or to devote outsized resources to diligence. But now the good news. Infrastructure, resources, and networks all show promising momentum. LPs see encouraging signs in emerging data platforms and specialized impact intermediaries, as well as regional regulations, which many view as a net positive for transparency and market discipline. They also highlighted the growing ecosystem of frameworks and tools, but again, are eager for more harmonized and practitioner-oriented guidance. Networks was the single strongest pillar of the framework and a powerful compensating force. With standards still evolving, LPs are relying heavily on peer-to-peer learning and industry initiatives. Finally, it's important to note that in our research, we found that over 70% of the LPs we interviewed and surveyed do plan to increase their allocations to impact investing. This was a committed group stewarding almost $20 trillion of capital, but we have to bring real urgency to efforts that might move the needle in any of the five areas I've discussed. Without strong market conditions and investors' internal orientation and the external operating environment become more powerful determinants of institutional participation. And we know these factors can be more difficult to influence. So, Matt, back to you. I'm really excited for the panel.
Thanks very much for the overview, Ben. And if folks will allow, I'm going to take a minute just to introduce our panelists today. So first up, we have John Herstrit, Managing Director, Sustainability and Impact Investing at GCM Grosvenor. The firm currently manages more than 10 billion across climate and socially impactful thematic investments, and John's team specializes in creating custom private market solutions, partnering with clients to design and implement flexible portfolios tailored to the sustainability and impact themes most relevant to them. Next, we have Paula Langton, a partner at Campbell Lutyens, where she leads the firm's sustainability practice, advising GPs on strategy and fundraising. She has over 20 years of fund placement experience, and today, Campbell Lutyens has raised or is advising on 52 billion in funds and transactions in the climate and wider sustainability space. Then we have Diane Mack, Head of Impact and Sustainability Private Markets at Allianz Global Investors, where she oversees the impact strategy and sustainability strategy, due diligence, and management across the firm's private markets platform. She brings deep experience from roles at TPG's Y Analytics and Social Finance UK, and is a recognized leader in the impact investing, including as a co-author of CFA UK's Impact Investing Certificate Curriculum. Last but not least, we're joined by Karen Raz, Head of ESG and Impact for Private Equity at APG. Karen led the build-out of APG's firm-wide impact framework and has led impact and ESG underwriting on dozens of private markets deals, helping shape APG's forward-looking approach to ESG and climate. Thanks very much to all of you for joining us today. Diane, we'll start with you. And really, what I'd like to do is dig into some of the barriers and enablers that are at play with the market institutionalization framework that Ben presented. As you look back, Diane, what were some of the more significant barriers your institution faced when engaging in impact investing, and how have you practically worked to overcome them?
Thanks, Matt, and lovely to be with you all today. And congrats, ILPA, Tideline, and Campbell Lutyens on this very insightful report on the state of the market. So I think harking back to some of the barriers, right, and workarounds, I think the first one, which probably is not a surprising one, is the trade-off, or the perceived trade-off, if I could say so, around impact and financial return. So this was something that we worked very hard both internally and externally to try and communicate, both with tangible examples of pipelines and also really talking to each of our investors in terms of that risk return impact profile that we want to target, to make sure we're setting realistic expectations in terms of what kind of market rate returns we could generate for them, right? So I think that's still a fundamental question that we get asked every day, even early today in a conversation before this call. So that's the first one. I think the second one that I might mention is the concern around impact and greenwashing. And again, this is nothing new for the industry. But when we first started, whilst there were some great frameworks out there, everyone was defining impact and measuring impact in slightly different ways. And even though we're now a little bit more converged, there's still some way to go. So it's really important for us at the get-go to really set out our own impact approach and framework so that internally we can be consistent across our private market strategies in terms of how we assess for impact and how we articulate that impact back to our investors. So I guess that's the second barrier. The final one I will mention is really working with emerging managers at a smaller scale. So obviously, most of our clients are institutional investors. It links to a resourcing point as well, where we get asked, well, internally, you're using maybe even more due diligence resource than we would typically use to deploy into a traditional non-impact PE fund, but you're writing smaller ticket sizes. So how does that work, right? And there were a couple of workarounds that we tried out in one of our pilot impact funds. So when we're looking at PE fund or fund strategy, we tended to diversify across larger buyout funds that have maybe a little bit more track record and mix that with specialist impact growth funds that we wanted to test and try out. So it's a little bit more diversified in terms of portfolio allocation. For our emerging markets PE strategy, we used first loss capital from DFI partners to make sure that we can still leverage institutional capital into that space. And then finally, we really tried to build out our sustainability and impact capabilities, both at the central platform level, but also in the investment teams, so that there's more pattern recognition, more streamlined due diligence, and to address that question around resourcing and how we can be more efficient around this.
Thanks. And Paula, maybe you can help us unpack a couple of the things that Diane just mentioned, particularly around returns and track record. You work with a large number of clients. So how have you seen factors like track record, scale, and measurability influence how LPs are allocating capital to impact?
Yeah, thanks, Matt. And it's been a pleasure to be involved in this report and a partnership and speaking today. So actually, I'll take the scale point first, if I may. And, I'm delighted that there are hundreds and hundreds of impact and sustainability funds out there, and there remains billions of capital required to fulfill climate goals, SDG goals. But if I take an example of some of the conversations we have with LPs, I had a call yesterday with a large sovereign wealth fund. They want to commit 300 million to 500 million tickets per fund into energy transition, which means they've ultimately got to do funds that are 3 billion or over or go direct. And actually, that's not an atypical call. So it's great news. We've got large LPs. They want to spend large sums of money. They want to increase allocations. But large LPs often want fund threes plus. They want funds of over 2 billion, 3 billion. They want energy transition, climate buyout, developed markets, existing track records, or ideally DPI over a number of years. And, if we think about the climate-only market, let's say, if we take that, we exclude diversified funds, we exclude sector-specific and social. Let's say there's 200 funds in energy transition and infrastructure. The average fund size for those is 1.6 billion. In climate buyout, which everybody wants, let's say there are 30 funds, there's more, but let's say it's 30 funds. The average size there is 600 million. And often the large percentage of those funds are funds 1 and 2. You look at, let's say, VC growth funds, let's say 100 funds, average size 5 to 600 million. many have got longer track records in that space. So if we think about that sovereign wealth fund, they've got maybe 30 funds they could actually invest in right now. But let's say if you lower that minimum ticket size to 50 million, you consider fund twos, you widen the purview to growth, you consider diversified versus climate. The universe expands from 30 to maybe 400 funds, just by sort of changing that and looking at that flexibility. So it's important, and we're seeing a lot of family offices and LPs like that sort of thinking about how to play that spectrum of funds and how to think about sort of the track record. And then if we look at the track record point very specifically, there's a number of data sets now sort of coming out, which is really important, whether that's groups like CREO or Cambridge Associates or others, or just having more time in the space with track records starting to come through. And some of those reports are showing that in many instances, some climate and impact funds are outperforming. That's a specified set, but the challenge is obviously it is very early. A number of LPs programs were set up in 2019, 2020. And many are VC growth. So liquidity will start to come through more in the next 18 months or so. And what's great is anecdotally, a number of LPs have started reporting early but strong performance coming through, and a number of their funds exceptionally having some really strong returns. And I think that one of the reasons that a lot of investors had gone into climate is because that measurability piece is so, I say easy, but it's relatively looking at one key metric. But I think ultimately the good news is there are a number of established, diversified managers out there, as well as climate, with multi-cycle experience and track records starting to grow. The question is really how quickly the ecosystem continues to develop for profitable companies and creating larger funds. But the good news is credible track records do exist, but perhaps they're with some of the smaller fund sizes.
Thanks, Paula. Karen, maybe turning to you, one of the topics that Ben covered in the overview was the power of networks, and actually that was kind of the area in our framework that had scored the highest in terms of its maturity and development. Could you talk a little bit about how relationships and networks, whether it's with other asset owners, advisors, industry groups, coalitions, can help LPs and maybe have helped your organization overcome some of the barriers that you've seen deploying capital with confidence?
Yes, of course. And first, want to thank Tideline, ILPA for putting out all these valuable resources and catalyzing these conversations for LPs on how to unlock impact investing capital. It's great. And it's especially great because we've seen and believe in the importance of networks, as you stated, to continue to advance impact investing. So let me give a little bit of background on our impact program and how we've used networks to get to where we are. So APG has a very long and deep history in ESG investing, and also in investing what we call sustainable development investments. About 3 years ago, clients decided that they wanted very ambitious mandates tied specifically to impact investing as defined by GIN. Specifically, one client has a 30 billion euro impact target by 2030. In order to implement these mandates, we really needed to build frameworks and tools that we could deploy at that significant scale and across multiple asset classes. And that initially that task fell to a small group of us who otherwise had full-time jobs, which is a reality I'm sure many other LPs will relate to. So with that, relationships and networks were so key to help us, and also because we did want to be aligned. Investing in companies and funds, we want to be aligned with where others are so we can be consistent with what we ask for. So very concretely, some of the relationships and networks that we leveraged, we connected to GIN and got access to trainings and their Iris Plus catalog. We looked at other LP and GP frameworks, including Allianz's, which is great to be on this call today with you. We studied and leveraged the operating principles for impact management. A consultant helped us think through how to measure outcomes across multiple asset classes. And then internally, we also leveraged a team of people from across functions and asset classes to support and advise us. And the output of that was underwriting templates for teams to use, a metrics library for teams to use, and also for us to share with managers. Trainings. I think our first training, we had over 400 people internally to help build capacity. And if I think about what in the end was also really important for us to build the confidence around deploying that capital, it was having these tools for deal teams to deploy capital with confidence. So the underwriting template was helpful because it gave them a sense of what needed to be analyzed to determine whether an investee would be impact or not. A reporting template so we could align with clients on how to report outcomes. And the GIN IRIS Plus framework was actually quite helpful because it provided a taxonomy and a set of concepts to really make impact investing concrete for deal teams.
Thank you, Karen. And I would say even though the networking component was the furthest along, that doesn't mean we should ignore it moving forward. I think for many investors, and particularly the folks that I've been speaking to, the community of folks investing in impact has been incredibly powerful at advancing programs, trading best practices, and thinking about really kind of how this industry moves forward. So appreciate you sharing your contributions there. John, a bit of a two-parter for you. We'll start with the first question, and then I'll pick up the second after. The first question I wanted to ask you is, to what extent have you experienced factors relating to internal orientation? So things like an investor's flexibility, risk appetite, and then the external operating environment that might influence an LP's capacity to participate in impact investing opportunities.
Yeah, thanks, Matt and Ben, for hosting this and including us. As Karen said, it's great to just have these types of forums, as we know different institutions are at different stages of kind of their evolution and life cycle. And I think this is a really collaborative kind of space, which is something I've always really liked. And so, Karen, Diane, Paula, it's great to be with you guys. So in regards to where we are, again, I think different institutions are at different stages of their life cycle. I think we have some that are early and curious and in that early education phase. We have others who are doing kind of pilot allocations. And then we have others like Karen and APG who have really advanced the ball and are doing broader implementation across their portfolio. But as you said, Matt, there are still kind of clear internal and external kind of bottlenecks that are slowing capital deployment at scale for big institutions. So if we start internally, I think the process for LPs starts in defining impact, what they want their impact to be, particularly in a fiduciary mandate kind of concept, and how to move from ambition to kind of something that's investable and scalable. And so, what we find is some LPs need help exploring goals and what outcomes they're trying to target, building theories of change, and really how to do this in, again, a returns first framework. We find, as Paula was saying, there's a lot of definitions of what type of impact and how people want to frame that, and it's highly bespoke. Some people talk about SDG alignment, others talk about net zero, climate positive, thematic exposures. We actually think that customization for LPs is really healthy. In Grosvenor's DNA, we build mostly custom programs. And I think in the impact world, it allows for a single institution to really determine how and where they want to be on that impact spectrum, and then figure out what the right managers or companies they want to invest in to support that. Again, I think the hard part is taking that ambition and translating it into kind of a investable solution. We know ICs are focused on diversification, risk-adjusted return, scalability, and impact has to compete on the same playing field as any other investment strategy. So what we've seen is that there's a real kind of key to reframe the opportunity set a little bit. And what we really like to do is talk about how you're really investing behind structural megatrends in many of these impact goals, whether that is energy transition, aging societies, resource efficiency. So we think that when you position kind of correctly, impact can align with structural alpha. And so that's really important. However, through that process, you will always have skeptics within your organization. We see many organizations that are having to prove ROI and efficacy, both internally and externally to stakeholders. And so where we think the industry really needs to kind of work is to counteract those forces through education and then track records. And when I say track records, it's not just GP track records. It's also actually looking at other LPs who have set that bar and set those programs. And particularly, how have they done with that? We've seen some large institutions come out and say, hey, look at what we did with our impact solution and look at how the returns are doing compared to actual other programs. And so, as Diane said, we all fight the daily battle of convincing people that this is not concessionary if done the right way. And I think those track records from both GPs and LPs are really important. Um, I think also, you have to demonstrate that impact is complementary to returns when done right, not competitive. And so we think the strongest investment examples that we have in our firm is when there is collinearity as impact scaling, that profitability of a business is scaling with it. And so, um, one thing that we've also done is, for instance, for people that want to invest in co-investments and directs, we look at impact at the portfolio company level, and that's allowed us to source from not only impact managers, but also generalist managers who actually are collecting the necessary measurement and have the intentionality at the company level, but might not label themselves as impact. And we think that's critical in widening that investable universe and increasing the probability that you can deliver, better risk adjusted returns. I'll also jump to where in the portfolio impact investing should fit is a common challenge. There's an ongoing debate. Should it live within the traditional asset classes? Should it be a carve out or a dedicated sleeve or team? Should it live in an innovation portfolio for a pilot allocation? We're also seeing kind of blurring of asset class boundaries and lines, particularly in something like climate. We're seeing that the leading institutions are seeing that there's a gray area of opportunity of investments or managers that are investing between PE and infrastructure, for instance. And so the willingness to stretch beyond those rigid asset class lines within impact can be really helpful. And then lastly, I'll say the external environment. We all know the policy shifts, the headlines being based here in North America, they clearly influence kind of support and governance. However, we're seeing institutions adapt thoughtfully. I'll give one example of a pension that we've been talking to who had a net zero framework that they were working on, and they've shifted a little bit to a broader climate positive strategy. That's allowed them to kind of preserve their intent and expand that investable universe. And then the second thing I'll just say is that, there are also other asset classes that are at different stages of their evolution within impact investing. So a great example is private credit. We know that's been the hot area for the last few years. Now we're seeing, alpha focused sustainable private credit strategies. We think it's early, but there's a lot of really interesting opportunity sets, but all the challenges that Paula talked about, is going to be even harder when you're in these earlier asset classes that don't have as much volume.
And I think, John, you really hit the call to action here, and ILPA hopes and looks forward to working with Tideline again to repeat this research in future years. But your call to action, on the LP side, share those track records. And I see one of the questions that came through the Q&A asking if there were any publicly available. I mean, if you're an LP organization, with a track record and some data that you might be willing to share on record, Ben and I would love to hear from you as we think about the next iteration of this research. And I think in that way, the more we can do to set the record straight, it really will be the rising tide that lifts all ships here. John, just really quickly before we move forward, I wanted to touch on one other point which Karen had originally made, and I think probably true of many, if not all, of the LPs on the call. Everybody has worked with advisors or consultants to some extent, particularly as they think about really scaling their impact mandates. Can you talk a little bit about where you've seen progress in the role that advisors and consultants play, and then maybe even, because I know we have a lot of advisors on the line, an area or two where you've seen advisors sometimes becoming a bottleneck?
Sure. So I think advisors have really evolved, as have GPs and everyone in the industry. We think that advisors are becoming far more fluent in translating those impact goals into portfolio aligned strategies. conversations now are more grounded in traditional kind of financial portfolio construction discussions, scalability, return targets, benchmarks, asset class fit. And I think that's important so that we don't make impact investing just this niche, strategy that's something different. I also think advisors are becoming more realistic in balancing underwriting from, a mixture of traditional financial, but also impact-oriented frameworks and assessments. I think where the frictions kind of remain is that we have a number of, consultants, for instance, that have come to us and said, we have a pocket of capital that's interested in impact, but the themes are often disparate or they're really narrow. And so how do we kind of construct scalable, diversified, repeatable portfolios or solutions if someone's only focused, for instance, on solving plastics in the ocean? And what we encourage again is trying to work with the industry to find that middle ground where maybe it's incorporating that theme into a broader circular economy theme or even more of a broader climate solutions program so that you can get the necessary diversification and widen that investable universe. I also think, just to be fair to the advisor community and consultants, the internal dynamics are going on there too. The investment teams need conviction. We are still constantly moving from ESG as risk mitigation and box checking to thinking about impact and sustainable investing as also a way to take advantage of structural growth opportunities in the world. And we saw that, inside of Grosvenor. We had early uneven adoption from certain teams. Our infrastructure team happened to be the fastest adopter because energy transition was just such a big investment opportunity set and the returns had been there for so long. But we've, had made great progress in private equity and credit and other areas. And so I think once performance evidence builds, advisors can really continue to shift from kind of cautious gatekeepers to accelerators of impact capital.
Thanks, John. Ben, I'm going to hand it over to you for the next line of questioning. But before I do, just want to remind folks, we'll be taking Q&A at the end of this. And so a few great questions have come through the Q&A function, but please feel free to submit and we'll look forward to taking a few of those as we wrap up the webinar today. But thanks, Ben. Over to you.
Great. Thanks, Matt. Yeah, I'd like to go back to you, Karen, and Diane. And we had discussed, I think, as we were doing the research ourselves, and I think as the findings were beginning to come through, and Karen, I think you have a lot to add here about this concept of convergence and the extent to which it's necessarily something that we should be aiming for in definitions, in measurement, in reporting norms, as a way of scaling institutional participation, or conversely, whether it's important to also allow space for flexibility. So this balance between convergence and flexibility, would love to hear, Karen, you begin sharing some ideas on, and then Diane, would love your perspective on that as well. Karen?
Yes, happy to chat on this. So I think convergence is really, really important. It is an enabler to becoming more established for the impact space. If you look at the future, if there's outcomes being reported, if it goes into annual reports, there's going to be auditing around that. Just as impact grows, the future is one where there does need to be more alignment and convergence. And also convergence can be transformative. I think on what has been done with the ESG Data Convergence Initiative. 5 years ago, the industry line was data is not available. Data is not available in private markets. We can't get it. Then the ESG Data Convergence Initiative was launched with a great idea. Let's start with a base set of common data points that people can collect for the majority of companies. And in just a short period of time now, over 9,000 companies are reporting into the ESG Data Convergence Initiative. We at APG Private Equity are getting data on a majority of our portfolio companies, which has been huge for us and now enables us to analyze ESG performance. So hugely transformative for us for what we want to do on ESG. And I think we can look at that for what's possible for impact. With that said, we want to be careful because with impact and with anything, you don't want to become too prescriptive too soon. And this is especially true for impact, where there needs to be room for innovation and evolution. So when I look at trying to find that balance, I think the mantra of EDCI was always progress over perfection and start with the low-hanging fruit. And I think that's the opportunity for us in impact. So as an example, I'm a part of the Impact Convergence Forum. Right now, it's a small group of LPs and GPs who wanted to find ways to converge. And one thing that we're looking at and working on right now is a DDQ, a due diligence questionnaire that we can find some convergence on that helps generate efficiencies for us as LPs, for GPs, helps streamline the information that we need to collect for diligence. And the DDQ would serve sort of as a floor. LPs could always add to it if they want to for custom things that they need. But that will help generate some efficiencies, also help us align on definitions, and serves as a baseline for future convergence, whether it be hopefully at some point in the future, metrics, methodologies, and more. And I'm really excited. One of the reasons I'm really excited about this call, having Tideline do the work and ILPA involved, is ILPA also especially has a long history of helping LPs with tools to use for investing. And I think tools like that will really support the growth of the impact space. But that does require some convergence.
Yeah, really appreciate that, Karen. And definitely our research, I think, validated the value for LPs in very practical efforts at peer-to-peer learning and the development of concrete tools. Diane, would love to hear your view on the same topic, like the right balance between convergence and flexibility.
I couldn't agree more with Karen. We're actually in the same Impact Convergence Forum group together, so have been learning a lot from that peer network, which is really important. I think convergence is for us is very important in multiple ways, some of which Karen mentioned. But for us, like in terms of decision making, the ability to actually compare and benchmark impact efficacy across investments very much how we do kind of financial comparisons, right, across investments will really help move that market forward. Because at the moment, we find that GPs and also LPs across the market are maybe using slightly different definitions and methodology. So one of the things that, for example, we tackled in the Impact Convergence Forum as a first go for measurement was around avoided emissions. And obviously there are methodologies out there, right? But everyone is using slightly different assumptions and principles. So even that, simpler metric for climate investing is sometimes not consistent across the board. And then when we try and aggregate and report out, again, there's so many footnotes and nuances that we don't feel comfortable actually providing that kind of impact figure out. So I think that is really important for us to start converging on so that we can be transparent and clear about what we're reporting on. I think the other tool that we found really helpful is the impact performance reporting norms. Obviously, again, very pleased to see LPs and GPs starting to converge around that as an emerging market standard. Improving that reporting quality in terms of what should be the key components in a good, high quality impact report that can then be verified independently is important for us also in terms of how we think about allocation and investment and being transparent. So I think all of that is in the direction of great convergence. I would say very similarly on the flexibility side that of course there needs to be a more tailored approach. For example, when specific portfolio companies do not have the exact KPIs to report on that Generis Plus metrics might be, providing. We need to tailor it to some of the specific business models. Enabling solutions is always a really hard one because it's not the direct generation of the impact. So again, we need to think through flexibility around that theory of change and how we link that to ultimate outcomes potentially over time. And then finally, I think especially for smaller companies we deal with and also emerging markets, they're just at a different stage of that measurement journey. So, having that mindset around collaboration and support and improvement rather than perfection is really important.
Great. Thanks, Diane. And yeah, shout out to some of the organizations that are driving convergence. Karen, you mentioned the Impact Convergence Forum, and Diane, Impact Frontiers with the impact reporting norms. Thank you for mentioning those, Diane. I think Project Frame on the avoided emissions question and their partners at Row Impact. So there's some great work happening that we're happy to sort of elevate and spotlight as part of our partnership with ILPA. Paula and Jonathan, turning to you both, and Paula, I'd like to start with you. Sometimes when we talk particularly about financial performance, it feels like there's not much we can do except to wait for, track records to manifest. But in your view, are there sort of real intentional actions that we can take as a market in the next few years to meet the kind of demands from institutional allocators we've been discussing, or do we simply need to wait? And if we can take actions, what should they be? Paula, I'll start with you on this one, and then Jonathan, come to you.
Thanks, Ben. So I'll run through 6 themes or actions. So the first one, which Ben, you covered at the top, which is around the secondaries, impact secondaries. So yes, the industry needs DPI, but let's help generate that. So from a GP perspective, whilst full exits are preferable, we can see the growth in continuation vehicles around some of the really great assets out there. With impact LPs, some are coming out the space, maybe it's some of the corporate LPs. Considering selling your fund stake, will really help your GP to attract more capital and to do some flexible things with it. Second one is around flexibility. So John and I have covered that, around LPs potentially broadening the lens of what they'll consider, whether that's risk appetite, whether that's flexibility around investment themes, size and scale, and asset class, or indeed geography for that matter. The next one is around emerging manager support. So whether that is more accelerator programs and the use of consultants, as we talked about earlier, so funds 1 and 2, and getting comfortable with some of that smaller tickets. But arguably, this particular space does give you better access to alpha. And certainly in the wider fundraising context, we're seeing actually quite a few LPs moving perhaps down from the large cap space to maybe the mid and low cap markets to get more alpha. The next one is around building of internal support, so for capital allocation. And, we have seen some teams that maybe have refocused, gone off the boil a bit. They've got distracted by AI, they've got distracted by defence, they've got distracted by some of the political background. So, it comes back to the investment case of that. We've touched on that a little bit earlier in the call around building those success stories, the strong realizations that have occurred in the space. And it does remind us a bit when we first started out in sustainability, you do have to convince new participants to come in and turn their heads. And, you can get, it's not an either or necessarily with something like an AI or defence when energy security matters so much. It's such a key topic. The next one is around collaboration. So we have mentioned this on the call already, but whether that's the point Diane made about shared due diligence, or whether that's around pooled vehicles or co-investment and SMA, just to help managers scale faster and think through some of that flexibility. And then the last one, again, which we touched on briefly, is around the transparency on returns. So it is publishing perhaps more data, it is publishing those success stories. And some of the sustainability fundraising for some managers right now can be tricky, but actually we've seen in the wider market some of the best performing vintages have often been in some of the hardest raised funds when times have been tough. So I think there's real outperformance there. So track records will come, but there's lots that can be done in the meantime, and there are track records already there.
Yeah, some great ideas, Paula. Thank you, Jonathan.
So I'm only going to go with 2 because Paula had a lot there, which I thought was great. I think that, look, what I really like about this industry is that everyone's evolving constantly. And so we're not just sitting here waiting for track records. Everyone's doing lots of things. And I think that's really important to add value. And I think one specific example of that is that with some of the political headwinds, the focus on value creation and storytelling, and again, how to really show that impact is not just kind of concessionary to returns, but can actually be part of the solution of driving kind of alpha and new strategies. And so I think GPs are getting better at that, at articulating the value creation, whether it's on the cost side or the kind of top line, revenue opportunity set. I will say to Paula's point, we've been a leader in small emerging manager programs for a very long time, and there's a lot of similarities in the development. What we think is that, in SEM space, it took investors a long time to be convinced that there truly was alpha and scalability for small emerging managers. I think today people forget because so many large kind of pensions and sovereigns and big institutions kind of have bought into that being a real part of their program. The other thing is that we have had relationships with large pensions who have said to us, we cannot have line items that basically are investing into a single manager or a company at 20, 30, 40 million dollars. It creates havoc operationally. It's too much noise. It's too much resource. And so what's happened in the small emerging space is that they've found partners like Grosvenor or others who are willing to basically say, give us $500 million and we'll split it up into 10 different checks underneath that, and are willing to do that legwork on behalf of that. And I think in the impact world, like as we get to more and more scalable deployments, utilizing partners in different ways that can be extensions of staff and resource can be really helpful. I also will say that to Paula's point, structures are really important and evolution of structures. The standard fund structure isn't always the best fit in an impact strategy. And so early progress might require kind of customized partnerships, owner-oriented capital solutions, hands-on value creation, and utilizing all the tools in the kind of implementation book. So co-investments where you can get much more transparency and closer to the assets with more say and stewardship and engagement. Secondaries, as Paula mentioned, we think there's a real opportunity there for that market to develop. And candidly, the secondary market is so big that it can't focus on the traditional impact kind of GP or asset. And there's probably a real opportunity set there, completion vehicles, all of these things. And then lastly, I'll say, purpose-built structures for first movers. We are ideating with someone right now who is kind of willing to build a proof point to, again, show other large institutions that this is an attractive space and that the track records can be there from the LP side. So I think, again, structures, storytelling, all while track records are developing can be really helpful to the space.
Right. Thanks, Jonathan. Fantastic ideas. Matt, I think we're just going to have to publish this transcript for folks to to benefit from just the incredible comments that are coming in. But Matt, I'll turn it over to you to begin sharing some of the questions from our audience. But thank you.
Yeah, sure. I think the first question will just be, Karen, for you, a quick hit. For folks who may be interested in learning more about the Impact Convergence Forum and some of those efforts, is there a website, or is the best way to learn more just to get in touch?
There is a website, but also feel free to reach out to Diane or myself.
Great. Maybe we can pop a link to that website into the chat if that's possible. And then next question, maybe for you, Diane, or for John. Diane, we'll give you the right of first refusal here. But for folks who are thinking about decision making, governance, and getting investments through investment committees, particularly where you start to get into some of the more bespoke or niche mandates where these investments, aren't as scalable or aren't as familiar to ICs. How do you think about that and kind of, more generally just approaching impact through the eyes of an investment committee, particularly one in the earlier days of an organization's impact journey?
Yeah, very happy to start and have John complement. So I'd say there are a couple of thoughts that come to my mind. First is it's really important to raise awareness and educate really the IC because as mentioned in this question, a lot of I would say IC members who have been used to quite traditional managers, maybe looking at vintage 5 and 6 as opposed to vintage 1 and 2, right, on a regular basis, with quite a lot of track record, and it's a top up repeat investment as opposed to a totally new manager that they haven't heard of. So I would say that in the early days, and still the case, we spend quite a bit of time sort of almost piecing together some of that track record from emerging managers. It might be that they haven't worked as a team before, but they have individual track records that, we can draw on, even if it's not presented as the track record of the fund, right? But like their individual investment experiences. And then also just providing that line of sight as to, why this kind of diversification into this type of manager is beneficial for the overall portfolio, because working with mostly large institutional investors, we're generally not able to have like a full portfolio that's all emerging managers. But if there's some alpha or upside or specific specialist thematic area that a manager is highly skilled at and can bring that industry knowledge and technical assistance to the portfolio companies that they invest in, then there's an actual investment argument on that value creation point that John mentioned, as to why we might want to look at these kind of managers. So maybe that's the first answer. Let John complement.
John, and maybe we could weave in another question as you kind of think about the response here, because I'd like to get your perspective on this, and then maybe Karen, we can get your perspective. But John, as somebody who's designing impact strategies for clients, and then Karen is somebody who's had to think about how your organization is really mobilizing and growing its impact portfolio. What are some of the key factors that an organization should be considering? So thinking about primaries, co-investment, secondaries, or even just sustainability themes, right? If somebody was looking to get started, how would you recommend they tackle this? And then Karen, we'll come to you to take the same question more from an internal perspective.
Yeah, so I think that in terms of themes, again, it depends on what they're trying to achieve and what they care about. Not every institution has the same goals, and that's okay, particularly in impact investing. So I think it's what we often try and do, and others advisors do, is help people kind of go through, okay, what are the things that you care about? Where do you see the investable opportunity sets? Where do you see the impact outcomes? And then marrying that with experience of where is the deal flow? Where is the opportunity set? Where are the track records or some of the kind of efficacy? And then as you kind of go through that process, then helping them to think about kind of the evolution of the sophistication of their portfolio. So you might start with funds, but then realize that you want to start to do deals and to underwrite deals and source deals. That's a different process than just underwriting a blind pool fund. And then maybe you start to see the opportunity in secondaries or things like that. So I think those are all normal kind of patterns of evolution for diversified asset managers to help, people think through that. And I don't think impact is different. It just starts, I think, a little bit more customized on, again, what are the financial and kind of thematic or impact goals that they want. I will say one thing back to Diane's point, which is we were really intentional when we set up our systems on how to resource. And so we wanted everything to run through our system in a returns first structure. And so what we've done is we have a centralized team that I lead, but we also have embedded kind of sustainability and impact leads within the actual asset classes and the underwriting teams. And that's purposeful because we want them on a deal by deal basis or a fund by fund basis, really kind of being our partners in helping to take those frameworks that Karen discussed. So, we use the impact frontiers and different things like that, but really embed that in the day-to-day activities. And also, though, be looking at not just impact solutions, but other solutions out there. And then, so to your point of when you then bring it to an IC, I agree with Diane, there's a lot of kind of education. But I will say LPs can play a really big role in that, particularly in a custom solution, because we work really hard to partner with our LPs to say, what do you want? How do you want to kind of define what fits or doesn't fit? And so as things are going through the IC members are thinking about, okay, what did the client specifically ask us to do? We're looking to make sure this is a great investment opportunity, but we also have to make sure that it fits the bounds of like what they're doing. And so I think that's where kind of comfort grows over time as more LPs kind of raise their hand and say, this is really important to us, and this is specifically what we want to do with you. And then the investment teams and the ICs kind of develop kind of expertise as they see more volume of opportunities kind of come through that.
I guess to build on what John said, from an internal perspective, what he advised is pretty consistent with what our approach has been and would be. Really focus in on what are the priorities from a thematic perspective, from an impact perspective, open to all themes. Are there only a specific number of themes? Also, what are the risk return requirements and the institutional requirements? And then what is available in the market that meets that? And then really build the impact program and priorities from there. We're doing impact across infrastructure, real estate, private credit, private equity, and we're seeing great opportunities across all those asset classes. And so there's really, depending on where an LP wants to focus, there's some great potential. And then I would add that to really also focus on not just designing the program, but building the capacity, as Diane and John have spoken to. That's so critical for impact, not just to bring the IC on board, but all the teams that are involved in evaluating investments. And building that capacity will also help establish an impact program sustainably at a firm.
Matt, can I just add one thing? We also see that in a lot of institutions, the decision-making power on who's kind of has the execution rights and the underwriting varies in those structures. And I think that's really, really important because I think a lot of institutions get trapped where they want to keep it within the asset classes, but the asset classes are run by people who are not impact focused or they haven't bought in necessarily or integrated. And so if you look at the most successful institutions, there's really kind of like that top-down vision and buy-in that's then pushed through the organization, or they've carved it out in some effective manner where they're still working through their normal processes, but there's really explicit kind of, I don't need the approval of the general infrastructure person or the general PE person and the impact person all to get something done. Because when you're in really, really large pensions or sovereigns, if there's not really like a shot caller or a portfolio manager that has that right, I find that it can really get buried very easily.
Thanks, John. Karen, Paul, a question for you, and Karen, would love for you to weigh in as well. How important is the sort of growing practice of impact validation, impact ratings, as an LP? What are you finding in the market as the market becomes more mature and institutional? Does that layer of assurance count for a lot?
So the conversations I have are probably more financial returns and a little bit more about the strategies of the underlying GPs. There is definitely a lot of focus and interest in terms of how GPs are thinking about the purity of approach, the data they collect, but often the investment decisions, the framework they've put in place to select the managers in the first place, and the strategy and the track records comes first, and then the diligence around the frameworks, how the manager collects the data, and those parts often come second. So that's certainly the experience that we've had. But Karen, from an investor perspective, I'm sure you've got strong views.
So for us, specifically when we invest in funds, assessing alignment with the operating principles for impact management has been really important to us because it does lay out a helpful set of criteria to determine whether a manager will manage the assets consistent with impact standards and expectations. For us, the validation point is really becoming an area of attention when we look at the outcomes data, because there is no standard in the market for how outcomes are measured. And there's different methodologies, different models. And so we're really grappling with how do we collect and aggregate that impact data, particularly when it's not being validated. And so that's what we're looking at. Do you validate the process? Do you validate the figures? What does near-term look like? What does long-term look like?
Got it.
And I expect the long-term does have some form of validation or audit in it.
Got it. Well, thanks, Karen. We received a ton of questions. Thanks so much to all of those of you who tuned in and asked them. And sorry we didn't have an opportunity to get to them all, but we are at time, and I want to take the opportunity again to thank our panelists, Karen, Paula, Diane, Jonathan. Thank Matt for your partnership and co-moderation, and thank you all for joining us today for a fantastic Compass series. Please do visit the ILPA.org website to download the report. And thank you for being with us, Matt.
Thanks for having us.
Great. Thanks, everyone. We'll see you again on the next Compass series. All right. Bye for now.